Today, guys, we're going to be talking about two of what I think are a couple of the market's best kept secrets. I'm actually surprised no one is talking more about them because they seem to have really solid financials and offer some high-flying, fast-growing dividends. And with that said, I definitely think these two stocks deserve some more recognition and need to be on your radar for reasons we'll be going over in this video. So without further ado, let's get into it. All right, guys, now just jumping right into the first stock of the day. We're talking about Robert Half International, ticker symbol RHI, which is a staffing agency that connects employers to employees in primarily corporate industries like law, finance, accounting, marketing, technology, stuff like that. So if your business is looking for something like a bookkeeper or a graphic designer or a paralegal, you can go to Robert Half and they'll help you fill that position, whether it's like a temporary role or something more permanent. And they must be pretty good at what they do because in their latest earnings report, they announced that they recently ranked number one by Forbes on 3 prestigious lists of America's best professional recruiting firm, America's best temporary staffing firm, and America's best executive recruiting firm, which is the first time any company has placed first in all 3 categories. So good job to all of the good people working hard over at RHI. Now moving on, guys, getting into the financials of this company, there's a lot to love. And as you guys can see right here, the revenue is looking pretty strong, definitely trending up and to the right with the exception of 2020 right here. But other than that, guys, every single year in the last 10 years, RHI has increased revenue, and the same is true with gross profit. As you guys can see from this screenshot right here, their gross profit margin in the last 12 months is about 42.7%, which is just crushing the entire sector, which has a sector median of just about 29.5%, so it's 45% higher than that, and it's just a tad higher than RHI's 5-year average gross profit margin. So they are increasing profitability slowly but surely over the last 5 years. And one other big plus we're seeing on the income statement here is a decrease in shares outstanding. If we look back over here, we can see that every single year for the last 10 years, this company has bought back shares, which is great news for shareholders. If a company is buying back shares and decreasing the amount of, shares in circulation on the market, your ownership of the company increases. This is also good for the company too, because it means they have to spread out earnings and dividends across less shares. They can keep more of that, which if dividend growth and continuity is something that's important to a company, it helps them achieve that as well. One other big positive to investing in RHI is this company has negative net debt. So this company has more cash and short-term investments than they do total debt, which means that if they had to, guys, they could pay off all of their debt tomorrow and still have some rainy day money left over. Now, the last thing I want to touch on as far as this company's financials go is the free cash flow. As you guys can see right here, the levered free cash flow, it's kind of up and down, but, across a long period of time, it is trending upward, which is great to see. And if we scroll down a little bit, we can see actually this free cash flow per share is definitely increasing with time, which is a combination of them bringing in more cash flow, but also it helps that they're buying back shares and there's less shares outstanding. So there's more free cash flow to go around per share. Does that make sense? Now, moving on, getting into RHI's share price performance, you guys can see, year to date, it's down 25%. It's at a little bit of a discount so far in 2022, which is fantastic. I mean, in the last month, they're up a little bit. They're starting to make their way back up 4.7%. But overall, guys, things don't look too bad. The PE ratio is 12.82. And if we go over to the valuation page, taking a deeper dive into that, we can see that this forward PE ratio is about 21.6% lower than the sector median. So compared to some of the other companies within the industrial sector, RHI does look to be at a relative discount, and the same is true compared to this company on a historical 5-year average. The forward PE ratio is about 31.5% lower than the company's 5-year average PE ratio. So that definitely checks that box. All right, guys, now getting into the juicy stuff, talking about this company's dividend, there's a lot to love here. And as you can see, the forward dividend yield of 2.12% is kind of average, definitely, nothing crazy to speak of there, but the payout ratio is looking exceptionally low, 26.3%, which when you combine that with, their ability to buy back shares and also their negative net debt, I think that results in a pretty stable, reliable dividend that I can't see any reason it would be at risk of being cut, right? And then the 5-year growth rate speaks for itself, really, about 12%, pretty high 5-year growth rate, which is one of the reasons I'm intrigued by this company. And the dividend growth history is not too bad either, 16 consecutive years. And if we go over to the dividend history, we can see that they've been paying the dividend for the same amount of time. And let's take a look at this dividend history chart right here. So guys, that looks fantastic. All right, guys, now jumping over to the second stock of the day, we are going to be talking about Watsco, ticker symbol WSO, which is a company that was shown to me by my good friend Ty, aka Suzuki Man. Ty, thank you so much for recommending this stock to me. And for those of you who have never heard of Watsco, this company is the largest distributor of air conditioning, heating, and refrigeration equipment in the HVAC industry. And basically, guys, this is how their business works. So as you can see right here, let's say you're a homeowner and your AC unit breaks down or something like that. So you're going to need to call a contractor or someone who has expertise in the ability to fix that. You're going to need to bring them out so they could diagnose the problem and recommend a solution from there. And then what the contractor does is, based on their diagnosis, they'll go to, the Watsco store or their website or whatever and get all of the parts and the equipment that they need to solve the problem, and then they'll go back and repair your HVAC unit and you are good to go. Now, what's notable about this is most of the business that Watsco does is done on the East Coast. Think states like Florida, Louisiana, even Texas, which isn't so much the East Coast, but states where you definitely need to have your AC working or else you're going to be struggling big time. And having said that, Watsco is making an effort to expand into other markets and territories. And to do that, to grow the business and expand into these other markets, they are making acquisitions. And what's notable about this is the fact that they actually don't come in and completely take over the reins on the businesses they've acquired. Instead, they take a page out of Warren Buffett's playbook and let the in-place operators, those who have been running the business, who think they have a better understanding of the markets they're in, continue to run the business just as they have been, which gives Watsco the opportunity to focus on bigger initiatives and continuing to expand the market. Now, as far as share price performance goes, I will say Watsco doesn't appear to be at the greatest discount. I mean, so far year to date, as you guys can see, they're down under 2%. So not a huge drop year to date. And in fact, in the last month, they've really climbed a lot, up 16.6% in the last 30 days. And if we look on the right-hand side of the screen, the PE ratio really doesn't scream discount either, 20.16. And diving into this a little bit more on the valuation page, as you guys can see right here, this forward PE ratio of 20.16 is about 23% higher than the sector median. So compared to some of the other stocks in the industrial sector, Watsco is a bit more expensive, a bit more pricey, but it is at a better value in relation to this company's 5-year average. So they have a 5-year average PE ratio of 27.32, and where it's at now is about 26.2% lower than that. So compared to where they have been, this company does appear to be more affordable, but across the board, it doesn't scream discount, like I said. However, guys, if you're able to get Watsco at the right price, I think you'd be buying a really financially strong company. I mean, just like with RHI, we saw a lot of growth, and we're seeing that here too with the revenue. Even in 2020, like right here, it still was up compared to the years prior, and they haven't really skipped a beat. It's like the pandemic didn't even affect them at all. And on the other hand, guys, if we scroll down, taking a look at the shares outstanding, we will see that that is not the most desirable. So they are issuing shares over time. In fact, every year for the last 10 years, they have issued a little bit more shares. I mean, it's really incremental issuance, but it still adds up over time, as I'm sure you can imagine. And scrolling up, taking a look at the debt situation, going over to the balance sheet, let's scroll all the way down to the bottom, taking a look at that net debt. We do see that they have $386.7 million of net debt left over after you account for the cash on hand and the short-term investments that they can use to pay that off. So that's not too ideal, but guys, the silver lining here is if we go over to the statement of cash flows, we can see that they have plenty of cash flow coming in to be able to pay that off like within a couple of years. So it's really not too bad. I mean, in the trailing 12 months, they brought in about $180 million in free cash flow. So if that maintains, they could pay off all of their leftover debt within 2 years. So that's pretty solid. Now, moving on and getting into the dividend stats, things are looking pretty good here. We have a 3% starting yield, a little bit higher than what we saw with RHI. But with that, we do see a higher payout ratio, nearing 60%, which for a company like this would be kind of on the higher end of where I'd like to see it. I think 60% or so is kind of like the max. Really, anything below that is preferable, guys. And then moving on to the 5-year growth rate, that's looking really sweet, 13.5%. So we're seeing some high growth coming from the dividend, along with 8 years of consecutive growth. A little bit of consistency there, but if we go over here, we can't see that they have been making payments, not growth, but making consecutive payments for 28 straight years. And if we zoom out here, taking a look at that chart, yeah, take a look at that, guys. So it looks like they cut the dividend back there in 2013 after paying what was probably a special dividend there at the end of 2012. So not too bad. And with all of this said, guys, I want to hear from you now. Between the two companies we've talked about today, RHI, Robert Half International, and Watsco, WSO, which one do you think you would be more likely to invest in, just based on what we've seen, based on the financials, based on the share price performance, the valuation, the dividend stats? Which one is piquing your fancy? Let me know in the comments below. All right, guys, now switching gears and getting into the weekly portfolio update, I got to say my portfolio is sitting at all-time highs. This is the first time I'm seeing it above 39,000. So we're currently valued at $39,093.20. Compared to this time last week, it was about $800 lower. We were at $38,237.75, and there is quite a bit of a jump in unrealized gain as well. Right now, we're sitting at 6.39% compared to last week's 4.49%. So just in the last 7 days, I jumped 1.9% in unrealized gain and saw a pretty nice jump in annual dividend income as well. Currently sitting at $1,745.19, which is up about $8 compared to this time last week. I will say, though, it really was not an eventful week in terms of purchases. As you can see, the only stock I picked up this week was Starbucks. I invested $150 into Starbucks and got 1.73 shares. And the reason I added more to it this week, guys, is because I really want to get my average cost per share below $90 per share. And it's so close, like 2 cents away, as you can see. So I might have to contribute a little bit more to Starbucks next week, depending on what happens with the share price, because I really want to get that average cost below $90 a share. Now, moving on, let's see what brought my portfolio up so much this week. So my best performers right there at the top, we have ORCC up about 4.5% in the last week. We have EPD up about the same, 4.5%. And moving on, Chevron's up about 3.9%. We have AbbVie up nearly 3%, Snap-on 2.5%, Starbucks 2.4%, Altria Group not too far behind that. Some others in the 2 to 1.5% gain range. And then scrolling down, we had a few losers, but really nothing too crazy. I mean, Coca-Cola and Verizon barely lost any, but Main Street Capital Corporation and Johnson & Johnson did appear to take a hit. About 5% loss with Main and about 2.5% loss with Johnson & Johnson. But overall, guys, really strong week. Anyway, guys, if you want to learn about some more awesome dividend stocks to invest in, then check out this video right over here. In this one, I'm telling you about 4 of the best, cheapest real estate investment trusts to buy right now, one of which I might actually have to add to my portfolio. So click right over here, and I'll see you in the next one.